Thank you all for joining in today. We'll be talking about converting retirement and estate assessment plans to financial plans and life plans. One of the things that we'll just touch on briefly, if we look at the VisionWorks menu of training videos, you'll see that there are, of course, the training videos on financial planning, which I'm sure you're all familiar with now. But I also want to bring your attention to the videos on life planning. And you'll see here certain differences, especially in the flow of the process. Getting to the point where you can effectively create life plans is something which I believe should be everyone's ultimate objective. The main difference between a financial plan and a life plan, both being cash flow based, is that a financial plan is created by the advisor for the client, whereas a life plan is created by the advisor and the client working interactively or collaboratively together. So what we want to do today is have a look at this whole conversion of retirement plans to financial plans. So it started with our retirement and estate assessment plan. And as you'll recall, we had a very large financial shortfall. And what we did was we adjusted some vehicle expenses. So I'm just going to switch to the plan that we created and review the changes that we made to correct that shortfall. So as you'll recall, we adjusted some vehicle expenses. They're a two-car family. Come retirement, they'll cut down to a one-car family, so the car will go in 2035, and the sport utility will remain through Sue's life expectancy of age 90. We reallocated portfolios. The rate of return that they were earning was very low, so we increased that rate of return. We did some tax optimization work, and I've gone back and done some more of this, especially in the area of withdrawing from retirement plans only up to the first tax bracket, and then any further income needs were withdrawn from the TFSA, at least to begin, as long as there were assets in it. And then a couple of other things that we did included changing the names of assets just to make it more client-friendly. So rather than owned home, I changed this to 6 Hour Street, and I changed the cottage, the owned secondary home to a cottage. And then what we did, of course, was we downsized the home and moved into a condo. The one last thing I just want to remind you of is that the whole approach we take to retirement plans is that there are only two things you can do with money. You can either spend it or keep it. And by keep it, I mean save it in a non-registered portfolio or bank account, or contribute it to a TFSA, RSP, DCP, and so on. So what a retirement plan does is it asks the question, what are you keeping? What are you saving? And then other than the home and vehicle expenses that we've itemized, it assumes that everything else pre-retirement is automatically spent. We don't care where it's going. We just know that if you're not keeping it, you're spending it. So what we want to do now is convert from our retirement and estate assessment plan to a financial plan. And to do that, we need to close VisionWorks, reopen the plan, and click the Edit button. Say we want to now upgrade this from a retirement and estate assessment plan to a financial plan. And I would also recommend changing the name of it. I like to use little code RA for retirement assessment, FP for financial plan. So We just have to select the Financial Life Plan button. I've made that name change. We click OK, and the plan is automatically now converted to a financial plan. So what's the difference? It's essentially not a great deal to begin. If we go to entries, what we'll see is that we still have general expenses of 0 up to retirement, so we need to make that adjustment. And what we can do is say, well, you know, if these are the expenses that are spent in general over and above home and vehicle expenses, we could begin just by dragging this up to the $50,000 range. Now, the other difference, of course, is that pre-retirement, any excess cash is not being spent. So if we look now at the net cash tab, what we'll see is the estimated savings capability over and above TFSA and RRSP contributions. So you can see it's $2,600, $4,800, and so on. Not too much, so $50,000 is probably a fair estimate of what they're actually spending over and above home and vehicle expenses. I want to point this out because you'll find that when you do a conversion, very often this pre-retirement excess cash can be quite substantial. A couple of days ago, I was assisting somebody with a plan, and when we did the conversion to a financial plan and looked at the free cash flow, it was running in the neighborhood of $70,000 a year. And what that simply said was, given that these people did not have non-registered portfolios of any substance, what it said was what they had estimated for their home and vehicle expenses may well have been reasonably accurate, but what they were estimating for their general expenses was likely substantially short of what they were really spending. So when you do a conversion, I think it's very important to have a look at this and say, is there a lot of excess cash flow? Because if there is, then it's very likely that the spending expectation in retirement is quite low. So I think this becomes a very good double check, and then we need to perhaps talk to people about what are you really spending. What I want to do now, though, is talk about this whole idea of converting from retirement plans, will I be okay in retirement, to more robust financial plans. So I'm going to take the Your Plan solution, copy it, and all I really want to suggest today is that we think in terms of adding more specific expenses, particularly expenses during retirement. So I'm going to call this vacation expenses as an example. So what I'm essentially saying is that having a plan which is based on home and vehicle expenses, financial planning tactics, and only a general expense number such as $50,000 is not particularly emotionally engaging for people. It's fine perhaps for the math, but from the point of view of emotional engagement, it leaves something to be desired. We all think in terms of mental images, and mental images, take a winter vacation for instance, we're now imagining skiing or going to the Caribbean or going to Mexico or whatever it might be. Mental images actually create an emotional response. So by transitioning from a retirement plan to a financial plan, what we want to do is put in more emotionally engaging content, and that's going to help make the plan much more realistic and involve our clients much more in its use. So what I'm going to do is I'm going to go down and I'm just going to add a vacation expense. So we'll assume Bill and Sue currently spend $5,000 on a winter vacation. Come retirement, what they want to do is they want to spend $10,000, and they only want to do that for 15 years. So I'm going to add this in, $5,000 until retirement, $10,000 after retirement, and then what I'm going to do is I'm going to do an offset by dragging down the $50,000 to $45,000, and then come retirement in 2025, I'm going to actually cut it down then to $40,000. So I'm reducing the general expenses by the expected amount of the specific expense that we're adding in, the vacation expense. So it's just replacing one expense with another. Now, what's interesting about this is that it actually makes quite a difference to the financial forecast, especially later in life. So all we're saying is by including expenses in the general bucket, and especially those expenses that may not persist throughout retirement, we're actually overstating how much will be drawn on the various pots, and therefore, what the financial circumstances will be. So if we go back now and do a comparison, we can compare the plan, which was using $50,000 throughout, with the vacation expense plan, and we can see where the difference shows up. So if we look at total income assets, you can see that assuming that continued expense of $50,000 a year throughout the course of their life, the primary account actually goes negative. Of course, in the final year, we're talking estate issues. But the primary account goes negative by $300,000 by replacing the general expenses, reducing them by the amount of the vacation expense, but ending the vacation expense at an appropriate age. The primary account actually is going to stay positive, or the total income assets will stay positive. So that in and of itself is quite a substantial difference. And one of the reasons that I'm going to suggest to you that while starting with a retirement or a retirement and estate assessment plan will get the clients involved, it doesn't take much to improve the quality simply by converting to a financial plan, putting in specific expenses during retirement, assuming that many of them will not persist throughout retirement, and then doing an adjustment to general expenses just to reflect the specific expenses that you've added. So not only are we mathematically more accurate, but we're also now engaging people more emotionally because we're talking about those vacation expenses that they'd like to take. So one other thing that I just want to finish up with is that the name of the game when it comes to planning is really to master change. We all have to manage it, but the only way to master it is to use realistic planning software that acts as a practice field for real life. And VisionWorks enables you to help clients test their options and assumptions so that they can see the long-term impact and thereby make the most informed decisions possible. So as much as the industry is preoccupied with retirement planning, I'm going to suggest that what clients think and talk about most of the time is what I prefer to call their dinner table conversation. And it's things like, can we afford to renovate the kitchen? If we can, how much can we afford to spend, and so on. And it's the ability to be able to go in, create a more whole life plan, a financial plan, and then work with clients to help them understand the long-term implications of the various short-term decisions that they're trying to make where I really believe you'll position yourself in clients' minds as their chief financial counselor. So that sums up everything I wanted to cover today. Converting a retirement plan to a financial plan is literally a couple of clicks. We need to make an adjustment then to the general expenses to reflect the spending prior to retirement. And then my suggestion is you ask clients about, well, what are you going to be doing in retirement? Let's, get a little more specific, vacations, whatever it might be. Add those in because they won't persist throughout their entire retirement years. Then make an offsetting adjustment to general expenses. You'll get a much more accurate output, and you'll also, of course, get them much more engaged emotionally in the plan. And then once they're more engaged emotionally, we can start working with them in a here and now sense to provide immediate value. What are the things you're thinking of doing in the short term, and what are the financial implications? So I'm going to throw the webinar open now for any questions.
Everyone can talk now.
So anyone have any questions? So thank you for joining in today. And if you do have any questions, please feel free to let us know. We'll do another recording and post it on YouTube. Thank you all again for joining in, and have a wonderful weekend.